Chapter 1 Learning Outcome 1.3 Differences between bookkeeping and accounting. Difference in definition. Bookkeeping is a part of accounting. It is a process of recording, in chronological order, the daily transactions of a business entity, while accounting is an information system. It is a process of recording, classifying, summarizing, reporting, analyzing, and interpreting the financial condition and performance of a business. Difference in scope. The process of bookkeeping involves a preliminary work in the accounting. Accounting is more extensive and involving a thorough work beyond the bookkeeping. Person in charge for bookkeeping is the accounting clerk, while accountant in charge for the whole accounting process. Learning Outcome 1.4 Branches of Accounting. Accounting has several branches, and 6 of them are Financial Accounting, Management Accounting, also known as Managerial Accounting, Cost Accounting, Auditing, Public Sector Accounting, and Taxation. Let's hear the explanation about all this from my friend Sarah. Over to you, Sarah.
Thank you, Madam Tina. 1. Financial Accounting. Financial accounting is a specialized branch of accounting that keeps track of a company's financial transactions. Using standardized guidelines, the transactions are recorded, summarized, and presented in financial statement that provides economic and financial information in terms of financial performance and position to the external and the internal users. 2. Management Accounting, also known as Managerial Accounting. Management accounting involves preparing and providing timely financial and statistical information to the internal users, which are directors and managers, so that they can make day-to-day, short-term and long-term managerial decisions. Starting and maintaining solid and professional accounting practices is essential for the growth of a business. 3. Cost Accounting. Cost accounting focused on analyzing business costs and operations in order to determine the cost per unit of a product manufactured by manufacturing company, or cost per service given by a service company. Information about cost is important to value inventory, to set selling price, and to determine cost of goods sold. It also helps in controlling the costs and providing necessary costing information to management for decision making. 4. Auditing. Financial auditing is the process of examining an organization's financial records to determine if they are accurate and in accordance with applicable accounting standards, regulations, and laws. External auditing refers to the independent examination of an entity's financial statements and other accounting records that an entity publishes for the use of external parties. The auditor gives his opinion about the fairness of all accounting information examined by him. Internal auditing is performed to determine whether or not the policies and procedures set by management are being followed. An important purpose of internal auditing is to evaluate whether the activities performed by the employees at various levels are in line with the goals set by management. 5. Public Sector Accounting. This involves maintaining and examining the records of government agencies, and also to audit private businesses and individuals who pay taxes, and entities subject to other government regulations, which are businesses providing contract services to the government or organizations receiving government grant money. Budgets are among the most important considerations in government accounting, since government agencies and other recipients of government money are fiscally accountable to taxpayers. and must demonstrate compliance with the intended uses of budgeted resources. Malaysia Public Sector Accounting Standard is used by public sector entities in Malaysia in the preparation of general-purpose financial statements. 6. Taxation. It involves tax-related matters of a business enterprise. It includes computation of taxable income and presentation of financial or other information to tax authorities, required by tax laws and regulations of a country. Now, back to you, Madam Tina.
Thank you, Sarah dear. Let's proceed to Learning Outcome 1.5, Types of Business Ownership. At this level, we introduce 3 types of business ownership. 1. Sole proprietorship, also called sole trader. 2. Partnership. 3. Company. And here are some of live examples for each ownership. The characteristics of each type of business ownership will be described next. Number 1. Sole proprietorship, also known as sole trader. It is owned by one person. It is the simplest and the most popular form of business ownership. The source of capital is entirely from the owner. The profit of the business belongs entirely to the owner, as well as the risk of loss will be borne entirely by him or her, and known as unlimited liabilities. In the laws of regulation, it is bound by the Business Act 1956. There is no legal distinction between the owner and the business entity. The lifespan of the business is limited. And here are the advantages and disadvantages of the sole proprietorship business. The advantages are written in blue-black, while the disadvantages are written in red. Please take some time to read the notes in this slide. You may discuss anything you do not understand here with your lecturer. The characteristics of a partnership business are: it is owned by 2 to 20% for common partnership and 2 to 50% for professional partnership. It is governed by the Partnership Act 1961. The source of capital is from partners' contributions. A partnership agreement can be drawn up to define the profit or loss distribution and the rights and obligations of the partners. If no agreement is made, the Partnership Act applies. There is no legal distinction between all partners and the business. Lifespan of a partnership business is limited due to certain reasons such as argumentations, conflicts, and death of a partner. Some advantages and some disadvantages of the partnership business is as listed here. The advantages are written in black, while the disadvantages are written in red. Please take some time to read the notes in this slide. You may discuss anything that you do not understand here with your lecturer. The characteristics of a company are as listed here. It is owned by 2 to 50 shareholders for private limited company and 2 to unlimited shareholders for public company. It is governed by the Companies Act 1965. The formation of a company requires compliance with the rules and regulations set by the Registrar of Companies. The shareholders' liabilities are limited to their respective shareholdings. The company will be taxed by the government. The profits are distributed in the form of dividends. The lifespan of a company is indefinite because it is an independent entity. Here are some advantages and some disadvantages of the company. The advantages are written in black while the disadvantages are written in red. Please take some time to read the notes in this slide. From the explanation about types of business ownership, you may summarize all facts by preparing a table like this. This will help you to identify differences among 3 types of business ownership based on their characteristics.